It is good morning. If you guys could be so kind as to let me know you can hear me, the volume's okay. Just give me a 5 by 5. I appreciate it. I'm checking on Twitter. Thank you, mention Trader, William, Mr. Wicks. Thank you so much. Stuff, thank you. Alrighty. All right, so it feels like a lifetime since the last time I've done one of these. I'm not sure if it feels the same for you, but I feel like I've been away for too long. Man. So, as the title suggests here, I titled today's Shotgun Saturday, Lifts You Like a Feather. And admittedly, as I mentioned this morning, I had a pretty interesting dream, which I'm not going to talk about that, by the way. And I'm sure for the folks that are interested in lucid dreaming and all that, I could probably weave that into another Twitter space of another topic outside of trading, but it's going to be outside the scope of today. But admittedly, it was a heavy influence today because I thought about basically, you know, what is it I want to talk about going into this weekend? I thought about this entire week. I wanted to come up with something that was engaging. I wanted to have something that would be helpful, impactful, and try to promote some kind of, well, performance, some kind of improvement, some clarity, that type of discussion today. And a lot of the questions I saw that were coming to me to my video section, where the video section comments area are open, a lot of people asked, like, how do I know when not to trade? And could I talk a little bit about that? And what are the things that help pinpoint those things for you as a student are trying to learn what it is I'm teaching and hopefully try to adopt some of the mindset things that I've acquired over the years that help me to mainly avoid losing, where as a younger man, I was more prone to losing, jumping into these environments. So I will talk a little bit about that today. But understand that it's normal for you as a trader, as someone that's new, trying to learn how to do this, to feel like you have to do it all the time. Otherwise, it feels counterproductive. And it seems counterintuitive that you should try to learn how to trade to learn how to trade less. But that's in fact what you should do. And it doesn't feel that way. It doesn't feel that way because of the way the industry is built around commission based activity, everyone trying to get a piece of the action. And you have educators that are trying to sell you something. And I used to be one of them. You have brokerage firms that want to charge you commissions and fees. You have services and softwares that want to try to get a bite of the action as well. And all of those things, all those outside influences, they're all going to get paid before you do. Just like a job, tax man cometh. You can't you can't escape it. Okay, no matter how much money you have, in some way, shape, or form, if you're buying something, or if you're selling something, if you're acquiring something, or running a business, to some degree, you're gonna pay something in taxes. But in the pursuit of profitable, consistently profitable trading, the common denominator is avoiding overexposure and overleveraging. Now, overexposure and overleveraging, it's not me amplifying the same thing. It's two different things here. Overexposing yourself and your account to risk is not the same thing as overleveraging. Okay, to eliminate the overleveraging point of it, because it's easier to do that and shorter. Overleveraging is simply adding more contracts than you should be willing to take or that you should be allowed to do because there's an exorbitant amount of risk associated with trading more contracts. And a perfect example would be I'll just use the prop firm models because they unfortunately are guilty of this. Allowing 15 contracts for a $150,000 combine or whatnot, and only offer you amount of pseudo leverage or not leverage, but drawdown before they take away the ability to trade that combine or account. It's disproportionate. It shouldn't be allowed. And I think that is one of the things that should be cleaned up. If they're going to see the prop firm industry continue, I think that they should be more realistic. If they're really in it to help you win, they shouldn't allow you to blow your own brains out. Because if it's their model to try to coax you into doing it properly and trade like a professional, professionals don't trade with 15 contracts when they're only allowed to lose, a couple $1,000. It just completely flies in the face of sound logic. So over leveraging is not what I'm talking about when I say overexposing. So over leveraging is just simply doing too many contracts per trade, opening yourself up to monetary risk that is exorbitant based on the equity base that you're working with. So with that out of the way, overexposing yourself. That means going in more times than you should, chasing opportunities that you want there to be opportunities in these conditions. What conditions? Whatever that condition is that allows you for you to sit in front of the charts. If the markets are open, prices are fluctuating, you think that it's now open season, it's hunting season. Maybe. But understand this. While you may adopt that mindset that it's open season for you to go out there and start seeking opportunities to be Elmer Fudd and have your little shotgun in hand, you want to go out there and chase Bugs Bunny. You want to go out there and chase Daffy Duck. Okay, and if you don't know who that is, it's in the States, they're cartoon characters. And everybody starts off at the beginning of the week. They're all out there like, yeah, man, let's go. I'm going to find me an opportunity. I'm going to take me something home. And because the markets are trading, there's opportunities to trade. And everybody has this idea of what makes the markets go up and down. You overexpose yourself to what you think is a plethora of opportunities 24/7. The only opportunity that exists in that mindset or that, well, reality is the market itself sees all of us as us being served up on a dish, like a plate for it to devour. See, the market can chew us up, ICT included, can bite me, chew me up, and take from me. So I have to learn to avoid certain circumstances. Over the years, I've done that. I didn't do it quickly. I didn't try to get through it fast because I didn't understand that it was something that I would incur or have to go through because I was too limited in my understanding as a 20-year-old when I first started. The books didn't talk about these things. They just talked about following your setups, pushing your edge, trying to do more. Very little was ever spoken about doing the least. And if you think about it, it would be very hard to market that even today. You're going back to the 90s, 1990s for the folks that are millennial. Like my youngest son says, Dad, you're from the 1900s. like it's like centuries ago. But in trading, a lot of the industry today is young folks, and it's have it your way right now mentorships. They want it instant gratification. They want instant, feedback where profitability is overnight and it's assured. And they don't like to be told or reminded or encouraged that it's going to take a lot more time, a lot more energy and effort to get to that point. And some of you are going to fail, not because of the things that you learn from me or anyone else. It's just simply that you're not equipped to do this. And doesn't mean that you're forever ill-equipped. It just means for that moment in time, you may be ill-equipped, and you will have to accept the fact that you will fail on the temporary. Now that stays temporary if you allow it, but it becomes final when you choose it to be. So taking breaks, calling it quitting, whatever, that's normal. I did that. I did it dozens of times as a young man. But overexposing yourself is constantly seeking opportunities and insisting that they're there, forcing them. And because you know that there's a likelihood, there's a potential for the market to create opportunities where it might be big moves this coming week. It might be big moves in this coming trading session. There might be large range expansion days. If you're a commodity trader, we could see limit up or limit down days where the opening is the only fluctuation in price from the previous day's close, meaning that wherever the previous day's close was, when that commodity would start its trading for the day, it opens limit up, the highest it can move, the maximum amount of fluctuation in movement from the previous day's settlement price. It's not allowed to go any higher. And it doesn't trade off that. It just stays there. So when you look at a chart, it just looks like a little hyphen, a little dash. The open and the close is the same price. That's a limit up move, and vice versa. When the market's going down and it's dramatically being repriced, not buying and selling pressure, and that's how you know it's a myth. Buying and selling pressure is a myth. That's not what causes prices to go up and down. Because if that was the case, you're trying to tell me, and I make this argument all the time, a limit up day. It's lock limit up. Okay. Why can't I and why couldn't I sell out of my position? I wanted to take profit. I couldn't. You're trying to tell me that there's not one person out there that were interested in seeing any lower tick to be able to offer one transaction outside of just the opening price being the only price of the day? It's a myth, folks. It's a myth. So all of these ideas keep flooding into your mind as a trader, and you understand that we do this to make money. You might have other subordinate reasons. You want to look smart in front of your girlfriend, your boyfriend, and their family members. Carl. um, but the number one thing should be you're trying to make money. And that's a very powerful influence. It's very powerful. It will place you in the pursuit of things that are not really there. You'll chase things that are phantoms, like trend lines. That's why I literally call them trend line phantoms in core content. Because you want this to be a diagonal support level. You need it to be because it provides you the venue on which you're going to act on and say, oh, yeah, this is the time where I want to be a buyer. Because everybody's going to see that area too. And they're going to want to buy too because this imaginary two swing lows, if I extend a line from those two, that imaginary decision point in the future, everybody's going to have that same decision point and want to buy there too. And I capitalize on that. I look for opportunities for those types of things. And when you overexpose yourself, seeking opportunities where there may in fact be opportunities there, but you become the liquidity. But you won't see it that way walking in. You won't see yourself laying yourself on the altar of these markets. Sacrificially just laying yourself out there. Consume me, take me, pick me, burn me up. Dismember me. Willingly doing it. But you walk into that condition thinking that you're going to leave in a gain. And the only thing you've gained is experience about not, hopefully, wanting to do that same thing again.